All right, well, the top story for markets today, as Seana was just discussing, the jobs report and the labour market showing signs of resiliency, but there could be some concerns on the horizon. Now, employers adding 261,000 jobs last month, thousands more than expected, and employment rising slightly to 3.7%. Well, Michelle Girard, head of US NatWest Global Economics, joins us now to break down those numbers. So obviously this is just one of the metrics that the Fed watches. What are your big takeaways from this jobs data?
I think stepping back, even with the mixed messages, you have to conclude that the labor market is holding up pretty well in the face of what has been, I think, aggressive action from the Federal Reserve to date. I think it suggests that the Fed has more to do. The Fed has been signaling that since, on Wednesday, the Fed signaled that alongside their 75 basis point rate increase that rates were going to continue to rise. They might rise slower going forward, but that the Fed was believing that interest rates were ultimately going to have to head higher than they had thought maybe even a month ago. So I think this report is consistent, with the Fed's thinking that it's too early to think about a stop in the rate hike cycle.
Michelle, it certainly does seem like that, but it's interesting when you take a look at the market's reaction. We were up almost 600 points at the highs of the session. Of course, we're pretty far off those highs, but when you take a look, I guess, at any signs of weakness, you mentioned the unemployment rate, 3.7%. Just what does that signal to you, I guess, maybe is potentially the labor market finally slowing down?
Well, there may be some hints. As you said, the unemployment rate moved up as employment as measured by the household survey actually declined. So when the Bureau of Labor Statistics calls households and asks them if they're working, as opposed to looking at what employers say, they found actually far fewer people working than the month before. And maybe that's a sign of some easing, although that number is so volatile month to month. I think when you look at the hourly earnings number, that number came down on a year-over-year basis. Maybe that has peaked. There's some other signs that perhaps wage pressures are beginning to ease ever so slightly. To me, that is really something that would be such a welcome development for the Fed to see. If there is some cooling on wage pressures, then I think that would begin to get the Fed to feel a bit more comfortable or confident that, in fact, as we look ahead to 2023, inflation can indeed begin to move sustainably lower.
And Michelle, what about the quality of jobs that are still on the table? Because that seems to be an issue. Some of these lower paid jobs, still a lot of openings. Obviously, they were the hardest hit during the peak of the pandemic.
Yeah, we're still seeing a very high number of job openings. Now, I will say in this month's report, the job gains were fairly broad-based, and you did see a big gain in manufacturing, which tends to be higher paid. But you also, as always, saw a big increase in service employment, up 200,000. And, and there you did see kind of some splits in terms of some of the lower wage categories. But it was a bit evenly more dispersed. The truth is a lot of the demand for labor in those lower paid industries, it's just still very difficult to find workers. As you said, those sectors were hard hit. During the pandemic, a lot of individuals left those jobs and they've gone out, they've upskilled themselves, they've educated themselves. They're not looking to go back to those lower earning wages. And as a result, you're seeing still a real difficulty, I think, for employers to find and actually hire those workers or workers into those jobs.
So, Michelle, going back to what you were saying just a few minutes ago about what the signals for the Fed, you basically were saying that it kind of reinforces the current path of rate hikes that the Fed had been on. But when it comes to that next meeting, and there's a number of data points I know between now and the December meeting, but what do you think is most likely on the table? Could we get another 75 basis point hike?
We could, but as you said, there are a couple of very important inflation reports that will be due out. Our feeling is the inflation numbers may show ever so slightly some cooling, and that combined with the fact the Fed has already done a great deal, we think they will come down on the side of moving a bit more slowly. So we expect a 50 basis point hike. But I think importantly, whereas many perhaps had thought that would be it and the Fed would pause in 2023, we had all long thought we'd still see a couple of additional smaller rate hikes in the first half of next year. And I think the comments and the data, the comments we've gotten from the Fed and the data suggest that the rate hiking cycle is indeed likely to spill over. So we may get 50 basis points in December, but again, a couple of further actions in the first half of 2023.
And Michelle, what are you watching outside of what the Fed can do? Obviously, we've heard a lot about hiring freezes and layoffs, but we still see this very strong job market. What are some of the factors outside of the Fed's control that you're watching?
Well, I mean, in general, I think, for the Fed, there's the question is just what, how much will the slowdown in economic activity actually bring inflation lower? So, I think that's the question. We may see weak economic data. We may see the demand for labor fall. We may see job openings begin to pull back. It's not quite evident yet. But even if the economy slows, we've got to see some evidence that will transmit into lower inflation. And I think that will happen. And so I'm just watching for signs. Ultimately, the turn in terms of the market, the turn for the Federal Reserve being able to call a peak in the rate hiking cycle, it all roads lead back to when does inflation peak and begin to move sustainably lower. And so keeping an eye on all of that. And I think you've got to look at more than just how strong the economy or weak the economy is, because that may not feed back into, weaker growth may not feed back into lower inflation. I think keeping an eye on any signs of inflation or wage pressures moving lower is ultimately going to be the key for markets and for for Fed action.
All right. Well, we do thank you for joining us, Michelle. Girard, thank you for coming
Thanks
this
so much.
afternoon.